Ladies and gentlemen, good day and welcome to the R Systems Q2 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Kumar. Thank you, and over to you, sir.
Thank you, Gabby. I welcome all participants to R System Quarter 2 2003 earnings conference call. We have today with us Mr. Nitesh Bansal, Managing Director and CEO, Mr. Nan Sadana, CFO R System. Mr. Nitesh has recently joined R System as Managing Director and CEO. We have shared the presentation with the investor earlier today. Hope all of you have received that. We will start the call with opening remark on the performance of the company by Mr. Nitesh, followed by financial overview by Mr. Nan. Thereafter, we will have a closer statement by Mr. Nitesh. Subsequently, we will open up for a Q&A session. Before I hand over, let me read out the customary disclaimer statement on behalf of the company. Investors are cautioned that this presentation contains certain forward-looking statements that involve risk and uncertainties. The company undertakes no public obligation to update or revise any such statement. These statements may undertake revision because of new and future information or otherwise. Actual result, performance, achievement could differ from those expressed or implied in such forward-looking statement. With this, I am handing over to Mr. Nitesh for his opening comment. Thank you. Over to you, sir.
Thank you, Kumar, and good morning, everyone. Thanks for joining the call. Like Kumar said, I'm Nitesh Bansal, CEO and Managing Director for R Systems. And I wanted to start the call with doing a little bit of context setting of the space in which R System plays. And assuming that all of you received the presentation that was sent out, if you are referring to it, this is part of slide number 3. The engineering services market broadly is divided into 4 sectors. There's mechanical engineering, which involves the design of physical products, including aircrafts, medical devices, and those kind of things. There's embedded engineering, which is related to design development of embedded systems, which are like systems inside on mobile devices and wearables, etc. Software product engineering, which is really doing the design and development of software products that we use, like software that sits on our desktops and other things. And digital engineering, which relates to the world of IoT and AR, VR, and artificial intelligence, all the industry 4.0 kind of things. And our systems actually works in the last 3 or 3 out of the 4 segments, except for mechanical engineering. We work in embedded software product engineering and digital engineering spaces. And if you look at the general outlook of how the industry is shaping up, and this is based on third-party reports, the overall industry global outsourcing spend in this engineering services market is slated to cross almost $450 to $500 billion by 2025. And of this, the 3 segments that we play in, which is the embedded software products and digital engineering, will probably have close to 50% of that market share. And the good news is that 50% is actually growing at double-digit CAGR as compared to the mechanical engineering piece, which is growing at a low single-digit CAGR. So, all in all, we are playing in a very large segment of the overall engineering services market, and we are in the space which is slated to grow at a high pace. If we move forward, again, carrying forward the context, there are certain demand and supply side trends which are shaping the market, and some of them include stuff like embedded software platforms and digital engineering, which will become a key growth driver. And we are already working in that space. One good example would be we working with a media broadcasting software provider, helping them create the mixing of live feeds from video and audio sources the way you see, live television debates or live broadcasts of sports programming with commentators from outside. There is the Industry 4.0, the 5G, the customer experience, and the servitization side of ecosystem, which is again a demand-side driver, and we are well placed to take advantage of it. For example, we are already working with an affordable hotel chain in North America, revamping their customer experience through their mobile site. Also, one of the demand-side trends is that APAC and Europe will continue to grow in demand, with APAC probably growing slightly higher or faster than Europe. And given our presence in Europe and APAC, we are well poised to take advantage of that trend as well. We recently started working with a large utility provider in Central Europe, helping them digitize their entire customer experience and customer onboarding process. So all in all, the demand-supply trends shaping the industry are also helping us take advantage of those and kind of move forward. So given that context, quickly jumping on to slide number 5 with the key highlights of our financial performance. We reported a revenue of rupees 4,067.8 million in Indian rupees, or $49.51 million for the quarter ended Q2 ended June 23. This was a year-on-year revenue growth of 8.48% and an EBITDA growth of 22.2%. This translates to a net profit of 144.25 million rupees or $1.76 million. The earnings per share translates to 1.22 rupees. This is before non-recurring and one-time tax expenses. So net-net, the company's grown well, and I'm sure Manji will cover a little more when he goes into the details of the financial highlights. If we look at it from an H1 perspective, the reported revenue is rupees 8,108.51 million, which translates to $98.67 million, which is a reported revenue growth of 12.92%, and a net profit of 502.6 million rupees, or $6.12 million. The EPS translates to 4.25 rupees per share. Moving forward, if I look at the key highlights that this result represents, we have had a resilient revenue growth despite some macroeconomic environment changes where we are seeing customers go slow on their spend decisions or delay new initiatives. But despite that trend, we have seen good pipeline, good traction in the pipeline, good conversion, with 14 key new accounts opened during H1 of 2023. We serve 50 customers with revenues of over $1 million on a run rate basis. H1 EBITDA margins obviously have shown improvement, which is a result of efficient operations. And we have continued to build deeper capabilities and new technologies, including cloud, AI, and DevOps, which continue to be in high demand across our customer set. We've also invested in, or rather carried out, a strategic acquisition of Velocio, which is a product engineering company and digital solutions provider, working with enterprises across the globe in areas of cloud, DevOps, data engineering, and generative AI, and which has also helped us expand our India delivery presence to Pune, which is a hub of product engineering talent. So now, beyond Noida, we also have a big hub in Pune. I think with this, I will hand it over to Manji to maybe do a deep dive on some of the financial performance and the analysis.
Thank you, Niteshji. Good morning to all. Thank you, everybody, for attending the call. The presentation gives you detail of both Q2 as well as H1 2023. Revenue for the quarter was rupees 406.7 crore or $49.5 million, a quarter-on-quarter increase of 0.7% and year-on-year increase of 8.5%. Revenue for H1 was rupees 810.8 crores or $98.7 million as against rupees 718 crore in H1 last year. This is a growth of 12.9%. To some extent, our performance has been impacted by global headwinds, where some of the customers witnessing these softness in their businesses. The company added 14 key logos plus good potential for forming through cross-sell or upsell. Just want to highlight that these numbers do not include Velocio number, which was acquired on 3rd July 2023 and will be consolidated effective 1st July, that is in quarter 3. Getting down to Q2 gross margin, it was 34.8% compared to 33.6% last quarter. The margins have improved on the back of better price realization and efficient operation. Getting down to SG&A expense line, SG&A expenses have increased negatively by rupees 18 lakh quarter on quarter. In percentage terms, the SG&As were 20.1% this quarter compared to 20.2% last quarter. We have been able to spread the SG&As to improve margins. EBITDA in this quarter was rupees 60 crore or $7.3 million compared to rupees 54.3 crore or $6.6 million last quarter and rupees 49.1 crore or $6.4 million in same quarter last year. As a percentage of revenue, EBITDA was 14.7% in this quarter compared to 13.5% last quarter and 13.1% in same quarter last year. EBITDA for H1 was rupees 114.3 crores or $13.9 million compared to rupees 90.7 crore or $11.9 million last year. As a percentage of revenue, EBITDA was 14.1% in H1 compared to 12.6% in H1 last year. Our system has expanded EBITDA margin about 150 basis points from 12.61 in H1 2020 to 14.1% in H1 23 despite the challenging business environment through efficient operation. We continue to focus on technology and digital services. During quarter 2, the company has incurred certain non-recurring expenses relating to recruitment fee for hiring of new CEO along with one-time joining fee. Other income in this quarter was rupees 4.4 crore compared to rupees 5.2 crore last quarter. Other income mainly consists of interest income and net exchange gains and losses. Interest income for the quarter was rupees 2.7 crore. The exchange gains during the quarter was rupees 1.4 crores, mainly due to mark-to-market on outstanding forward cover. Last quarter, interest income was rupees 2.3 crore and exchange gain was rupees 2.6 crore. Since the company has now utilized significant corpus for acquisition of Velocio, it will impact our interest income from Q3 onwards. At the end of quarter, we had outstanding forward cover of $33.1 million with average rate of 83.4 and euro cover of 2.2 million with average rate of rupees 91.44. This has already been marked to market as on 30th June. Now moving to tax expenses. Our quarter 2 tax expense was rupees 31.1 crore as against rupees 12 crore last quarter. This quarter tax expense includes rupees 20 crore for provision for tax on dividend received from US subsidiary. Out of rupees 20 crore, the company shall be able to reverse rupees 12 crore based on dividend declared to its shareholder in next 1 year. Our effective tax rate during the quarter, excluding this one-time expense of rupees 20 crore, is 24.2% compared to 25% last quarter. Net profit after tax for the quarter was rupees 14.4 crore or $1.8 million compared to 35.8 crore or $4.4 million last quarter. Net profit after tax for H1 23 was rupees 50.3 crore or $6.1 million compared to rupees 61.5 crore or $8.1 million last H1. This is after considering non-recurring expense of rupees 7 crore and provision for tax of rupees 20 crore dividend received from US subsidiary. Resultant EPS for the quarter is rupees 1.22 and for H1 is 4.25. Adjusted EPS before non-recurring and one-time expense is rupees 3.30 for quarter 2 and 6.33 for H1 2023. Getting down to asset side on the balance sheet, DSO for quarter was 66 days compared to 54 days for quarter 4 2022. We are seeing some challenges with few customers who are dependent on funding last few quarters and have made conservative provision. Our cash balance was rupees 381 crore at the end of the quarter compared to 271 crore at the end of December quarter. We have been constantly generating cash from the business to support growth and expansion. Subsequent to the quarter end, the company has paid rupees 264 crore rupees for the acquisition of Velocio, which will impact our cash balances going forward. However, we have sufficient cash to manage routine operation. Our shareholder fund were rupees 595 crore at the end of the quarter compared to 545 crore at the end of December quarter. On the basis of geographical distribution based on customer location, North America contributes 72.7%, Europe 10.8%, Southeast Asia 13.3%, and the rest of the world 3.2%. Our client concentration, top 10 clients contribute 24.7%, with the largest client contributing 7.1%. I tried to cover highlights of the financial number. With that, let me hand over to Nitesh for closing and summing up. Nitesh.
Thank you, Nanji. I think summing up, all I would like to say is that H123 performance has been in line with the industry. We've delivered revenue growth and margin improvements in a challenging global environment. And I think that speaks of the efficient management being driven at the company. We have been concentrating on building deeper partnerships with customers while rapidly growing our core competencies and growth areas. So we are using both speed and relevance as our core differentiators, which is resonating well with the market. And we are continuing to develop new success stories during H123 and continuing to H223. So sharing a few of the success stories which are developing are as follows. AWS has selected us as a partner for their upcoming generative AI platform release, which is a small set of partners that they're working with. For a client in APAC, we are implementing Microsoft Business Central, helping them become more responsive to their customers. For a customer in association membership space, we built an AI module to help them map buying patterns and help them upsell and cross-sell products and services. For a national healthcare provider in mental health space, this is a customer in Europe, we are building a patient management system to help improve patient and physician interaction. And then, of course, the integration of Velocio, and which is going to further accelerate our growth with added capabilities and great potential to cross-sell, will obviously be a developing story for H2. So with that, I would end the presentation and open for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Agarwal, an individual investor. Please go ahead.
Yeah, good morning, sir. Thank you for giving me the opportunity. Sir, I just wanted to know, what's the 5-year vision of the company going forward? So if you could just please help us understand in terms of what would be your top line and margins going forward. So this is my first question.
So Rahul, thanks for the question. See, our 5-year vision as a company is to concentrate and get deeper with our customers in the space of engineering services to become one of the respected engineering service provider in all the vertical segments that we operate. To be able to provide a 5-year view of revenue and margin is honestly very difficult. We normally don't provide a forward guidance. And even if we did, 5 years would be extremely difficult. But clearly, we will continue to grow with the industry trends at the rate or better than the industry average. And that is probably, something that any of us can calculate.
Okay, thank you, sir. So just one more follow-up question. So as recently we have just concluded the acquisition of Velocio, so is there any further inorganic plans which the company has in the future?
So Rahul, as a company, we would be open to both organic. We are obviously focusing on organic growth, but also inorganic opportunities as they come by. We will be looking at inorganic opportunities wherever they are in line with our strategy and allows us to deepen our capability either in a vertical or in a competency space.
Okay. So like just on that, like how do we then fund this inorganic growth? How would we try to do this?
I would refer that to Manji. I think that's a question about how would we fund our investments.
Sure. So, Rahul, the funding will happen through various means. It could be equity participation in the form of rights issue, preferential issue, and some kind of a loan. I think let the target be firmed up. And I think, as Niteshji said, we want to grow. So I think funding and all that should not be a problem. With Blackstone backing, funding and all should not be a problem.
Great, sir. Thank you for the opportunity.
Thank you. Before we take the next question, I'd like to remind participants, if you have a question, please press star then 1 on your touchtone telephone. The next question is from the line of Abhishek Nagraj from Allswell. Please go ahead.
Hi, good morning. Thanks for the opportunity. Just want to check and understand, can you throw some light on the SG&A rationalization that you were talking about? Like, what are the steps taken? Was it removal of excess? Or just want to understand what were the operational changes that happened there?
Manji, you want to throw light on that?
Yeah, sure. Abhishek, this is a matter of growth. You see, the company has grown in the last 2-3 years. If you see, in the last 3 years, we have almost, grown from 115 million to now close to 200 million. SG&As do not increase in that proportion. Our SG&A, which used to be like 25% of our revenue, has now gone down to 20.2, 21. I'm in the range of 20 to 21%. All this rationalization is happening. Having said that, as Niteshji said, we have to grow. We have to invest in sales, marketing, but some kind of natural sweating and rationalization happens when you grow. So all these things will help us, in improvisation or efficiency.
Sure. The other question I had was, is there a waterfall that you can provide from the standalone numbers to the consolidated numbers? Like, what entities are adding to the profits? Where are we seeing, the reduction in margins, etc., from a standalone basis to the consolidated basis?
So, Abhishek, at a high level, our standalone business consists of the deliveries from Noida, that is for digital product engineering, and KPO business. At a high level, for understanding point of view, I can tell you that this is close to 50% of our business. So 50% of business comes from standalone, and the balance 50% comes from overseas subsidiaries. At a high level, close to 30 million comes from Europe, close to 40 million comes from US, and close to 30 million comes from Southeast Asia. So margins at standalone level are much better because these are offshore revenues. Margins comparatively are lesser at on-site as well as in FX. So that's the broad breakup. If you have any specific question, you can write an email to me and I'll respond to you.
I'll do that. Thank you so much.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Rahul Sharma, an individual investor. Please go ahead.
Yeah, hi. Good morning to the management. As we can see that the company has recently concluded big transactions with Blackstone and acquisition of LSU. Also, I saw that the company has received a dividend from its subsidiary. So, do company has any plan to pass these benefits or reward its shareholders through dividend or buyback or bonus issue in recent recently?
Nanji, you want to take that?
Yeah, sure. Thank you, Mr. Rahul. Let me explain to you. For the purpose of acquisition of Velocio, our subsidiary at US had surplus cash. So we transferred $7 million from US to holding company in the form of dividend, and that is we have to pay some tax on that, and that's a non-recurring item, which and the tax expense which I have explained in my note. So if we give dividend from India company to our shareholder, the tax expense will reduce. Like normally India is taxed at 35%. The tax expense will reduce to 15% if we do that. So that's a technical part of it. To your question, the plan for dividend or buyback, the company keeps on evaluating these options. The last dividend was given in June 2022. It's almost a year. So I think that will be evaluated at appropriate time in the board meeting. But as of now, we have to balance between growth and shareholder rewards. But these points do discuss in the board meeting, and the decision is taken. We'll do consider that.
Yeah, thank you. That's all from my side.
Thank you. The next question is from the line of Abdul Kadil from Ratnabali. Please go ahead.
Yeah, hi, this is Abhinav here and not Abdul. So my question is on this Velocio acquisition. I wanted to understand what kind of traction you are seeing there, what kind of sustainable EBITDA margin you see there, because the EBITDA margin reported on the exchanges for Velocio is northwards of 34%. So can you just highlight what would be the sustainable EBITDA margin, and post integration of Velocio, where do you see our systems consolidated margins to reach over next couple of years?
Manji, I think again, it's in your area.
Sure, Nitesh, I take it up. So, Abhinavji, the Velocio is having a revenue run rate of 15 million with close to 30% EBITDA. And as I said that the transaction is concluded on 3rd July. So at a high level, we will be consolidating, assuming the stable state of mind, we'll be having 7.5 million revenue in the H2, that is between July to December, with close to 2.3 million of EBITDA. So their EBITDA margin is close to 30% as against 14.5%, around 14.1% for our system. But please note that Velocio is purely doing offshore work, whereas our system business is spread across the geography, having on-site component as well. So to answer your question, at a high level, I feel that Velocio acquisition will be accretive in EBITDA percentages from 0.6 to 0.8%, depending upon final number which comes to. So that will be accretive. And, so that 7.5 million for the next 6 months on a run rate basis with 2.3 million should be added to our system number for the H2.
Okay. Now a follow-up on the R system answers. What would be the sustainable growth rate that we should factor in our models for our systems in terms of organic growth for next couple of years in terms of top line as well as EBITDA margins?
Okay, let me explain to you. In the last 2 years, our system has grown. In 2020 was a challenging year. 2021 was, after the COVID, there was a lot of growth. The IT industry has boomed, as everybody knows. We grew close to 35% in 2021, and we grew close to 27% in 2022. Now, as you would see that, the IT companies are having a bit of challenges because of the U.S. economic situation and all that. So, it is little hard to give a guidance how we will perform. But if you notice, in the first half, we have grown close to 11-12%. Year-on-year, quarterly, we have grown 8%, and H1 basis, we have grown 12%. So we are hopeful of reasonable growth in line with the industry standard, but I will not like to give you any guidance on that. Of course, Velocio acquisition will definitely add to our number.
Okay. Thank you. I'll come back in the queue.
Thank you. The next question is from the line of Mihir Manohar from Canadian Asset Management. Please go ahead.
Hi, sir. Thanks for giving the opportunity, and congratulations to Mr. Nitesh Bansal on joining our systems. I had a question on the GTM strategy. After you joining in, or do you think any changes required in the GTM strategy part of the piece? And also, if you can throw some light on some of the rationalizations, what are the steps that you are exactly taking on the rationalization on the SGA front? That will be helpful. What kind of impact are you expecting, let's say, from the steps, both on the GTM side and even on the operational delivery side? So just wanted to understand any impact are you expecting on that? If you can throw some number around that, that will be really helpful. My second question was just on the Blackstone portfolio. Given the fact historically we have seen for IT companies, wherever Blackstone is present, it gets benefit from the Blackstone portfolios which are there. So just wanted to get an understanding, are you looking at synergies from the Blackstone portfolio of companies? That was the second question. And just for the third question on the Velocio part of the piece. Just wanted to get an understanding around some of the identified synergies on Velocio, any cross-sell, upsell, that will be really helpful. So just wanted to get an understanding around these two things.
Okay. Thanks, Mihir, and thanks for your wishes. From a detailed strategy perspective, though these are early days and we are going to be firming up our strategy over the coming months, but broadly speaking, like I already said, from the market segment that we are serving, we'll continue to remain focused on that market segment, which is the embedded engineering, the software product engineering, and the digital services. So from a macro perspective, there is no change. How we attack the macro, I think the company has been doing a great job of slowly and steadily building deep domain skills across various verticals. So we are going to be deepening that, where we will go more deep in certain verticals where we have seen a lot of traction and we've got good capabilities. And also, like I said, we'll continue to invest in competencies which are in high demand, which include artificial intelligence, which include DevOps, which include a lot of cloud technologies and stuff. So you will see the company taking a much more aggressive posture or a more outward posture on some of these verticals and competencies, which is the way that we will try and essentially corner the market for ourselves. This is what the GTM portion of the strategy or the sales would look like. From a SG&A rationalization perspective, I think Manji already answered that there is really no significant reduction that we've done. It's actually rationalization as a result of expansion of the size of the company, where it's in percentage terms, it has rationalized, come down. As we go forward, we'll continue to invest in building those markets for us. So while there will be addition of headcount and new hiring that will take place in line with company growth, so it may not increase our expense in terms of percentages, but the net headcount will increase. And that increase will happen in line with the strategy. So you will see some more vertically focused sales people, maybe some more capability or particular competence-based, sales and consulting kind of people coming into play to help us develop those markets for ourselves. From a Blackstone portfolio perspective, you've got absolutely the right point. We are excited about being part of Blackstone portfolio. We are already seeing the benefits of it because we do get connected with a lot of other Blackstone portfolio companies where we are able to then cross-sell our services, where we are able to understand their needs better and be able to build some of our solutions and services for them. We have already won at least 2 accounts which are also Blackstone portfolio companies, and we are continuing to work on that angle to increase our inroads into Blackstone portfolio companies. From a Velocio perspective, like I mentioned, Velocio has got certain good vertical competencies, both in tech, storage, and media space, which are synergetic with us because we also operate in those spaces, and it gives us more depth. Likewise, they have good competencies in cloud and DevOps, which again are very much in line with our strategy and provides us depth and expertise, both in the vertical and competency sense. So we will see a lot more of cross-sell and upsell in those areas happen across our customers. And we believe that we are placed well to realize those synergies. I hope that answers all three of the questions, Mike.
Sure, sir. Yeah, that's really helpful. Thank you very much.
Thank you. The next question is from the line of Anand Mundra from Sorwell. Please go ahead.
Yeah, hi. Good morning, sir. Just wanted to check this dividend which you have paid taxes on. What was the need of calling the capital if there was no intention of giving back it to the shareholders? Because there is an unnecessary tax outgo from the company.
Mr. Anand, I did not say there is no intention. Okay, let me tell you. You see, at our system, as I said, that consists of holding company based in India, and it has subsidiaries overseas, USA, Eastern Europe, and APAC. So there was a surplus cash lying in USA. So when we wanted to acquire Velocio, I mean, you keep money distributed, at all the places. So that surplus cash was taken out and brought into India by way of dividend. Now, what I'm saying is that when you get any dividend income in India, it is subject to the marginal rate of tax, which is 35%. However, if our system declares dividend in next 12 months or so, then it can claim exemption for 20% part of it. So that's a normal tax kind of a thing. So that is what I was explaining to you.
So if our system declares dividend, 20% of the tax, or out of 35%, only 25% we need to pay, 15% would be reversed.
We need to pay only 15%, 20% will get exempted.
Okay. Thanks, sir. Thanks for this. One more question, sir. Generally, EBITDA margins of IT companies are in the range of, are slightly higher than 13-14%, which we operate in. Any guidance on that for whether it will come back to 20% or it can come to industry standards?
We are conscious of this. There is a plan to improve, but it will take time. You see, as an R system, we are distributed across the globe. In fact, sometimes I say that for the kind of distribution across the geography we have, our business model can take care of even 400 million of revenue. And that's the reason I mentioned SG&A sweating and all that. When we grow and become, a bigger company, a lot of SG&A sweating will happen, and that will help kind of, improve upon the EBITDA margin. But it will take some time.
Okay. Thanks.
Yeah, but I would just add one more point again. I think, we should not look at it as a generic IT services company and compare with IT services margins because, the engineering services do work slightly differently. And, the margin, while size will help us expand our margins definitely. But if you look at our peer group with similar sized companies, I think we are fairly comparable today also.
Okay. Thanks, sir. Thanks for this.
Thank you. The next question is from the line of Suresh Patel, an individual investor. Please go ahead.
Hi. Thanks for the call. Good morning, everybody. I just want to understand from the risk perspective, what are the major risks we are seeing in our business to give them a critical one? And what are the mitigation plans for the same?
So, Suresh, thanks for the question. From a risk perspective, major risk that we see is essentially the headwinds or the market sentiment, especially given that a lot of software companies who we work for, people who create softwares, like whether it's CRM software or accounting software or others, a lot of them are dependent on funding, whether they are venture capitalist funded, private equity funded, or funded through family offices. And that funding scenario becoming little unclear does create challenges with their ability to spend or expand on their product roadmaps, and that translates to a demand risk for us, and that to us is the biggest risk. However, what helps us is the fact that our client concentration is fairly wide. It's not like we are heavily dependent on any single or a few number of clients in this case. So it helps us even it out. The way we are mitigating that risk is we are obviously working towards deepening our position in digital and AI and those kind of things, which tend to give us larger size of revenue, longer time of engagement, etc. And also consciously positioning ourselves for longer duration contracts. So again, these are all work in progress, will take shape, but it's something that we are conscious of and working on. And we kind of see this as an ongoing thing for a bit now.
Thanks for the information. Thanks. That's all.
Thank you. The next question is from the line of Abhishek Nagaraj from Allswell. Please go ahead.
What is the FTE employee count across regions? And if we are tracking this, what is the revenue per seat that we are tracking as compared to our peer set?
Ma'am, do you want to take that?
What is the question? Can you repeat?
What is the number of FTE employees we currently have across regions,
sure,
and how are we tracking as compared to peer set?
Sure. As of now, we have close to 3,890 something employees, and close to 500 are SG&A kind of stuff. So close to 4,466 is the exact number.
And do we have a split across regions? And if
we have split across the region. I can explain to you a high level. So we have three businesses. The first is the digital and product engineering business. This business comprises of Noida delivery, where we have close to 2,000 employees. Then it is Eastern Europe, where we have close to 400 employees. And then US, where we have close to 200 employees, US and Canada put together. So digital product engineering piece, we have close to 2,800 to 2,850 employees. Then we have a KPO business where we have close to 850 employees. And in APAC region, we do two businesses. One is a business solution and second is the consulting business. Put together in that business, there are close to 450 employees. In addition, there are, as I said, the SG&A staff. So 4,460 is the approximate number across the geographies.
Understood. And in terms of revenue per seat, how are we tracking as compared to our peer set?
We are well in the range of, as I said, there are three businesses, so we have to look at from that angle. Our DP business is comparable to any IT company, engineering company, which Niteshji explained. The offshore margins are in comparison with the companies like, Birlasoft and Global Logic and all that, which are the peers. So that our, the revenue is more or less in the same range. And again, then, the KPO business is more technical, held as revenue cycle management. Again, the revenue per FT is comparatively lesser, but the cost is also lesser there. And then APAC businesses, based on that, it is quite comparable.
Okay, thank you.
Thank you. The next question is from the line of Gokul Maheshwari from Orisa Capital. Please go ahead.
Yeah, thank you. You highlighted the risk in the business in terms of ability to get funding for your clients. Could you highlight any risks which you see to any of your business verticals on account of changes in technologies, especially in terms of AI, or specifically any comment on the KPO business where you see an impact because of changes in technology where we get impacted?
So thanks for the question, Gokul. The short answer is we're seeing changes, but we're not seeing it impact us for a simple reason that whether it is the product engineering business or KPO business, we have always been very focused on automation and AI. And a lot of work that we do, even on the KPO side, is actually built out of carrying out automation for the customer while managing the business process or the knowledge process itself. So the fundamental value proposition that we offer to our clients is that we bring automation first. We implement the automation for them. We implement the AI wherever that is useful or needed. And then we carry out the remaining parts of the process manually, and hence taking care of the entire knowledge process holistically. So yes, we are seeing a lot of AI adoption. We are actively on the forefront of bringing it to our clients, and hence, since it is part of our proposition, it does not adversely affect us. It's actually a good thing for us.
Okay, so you're saying that this is a net add to us in terms of what the opportunity comes on account of AI.
I'm sorry, I didn't understand the question. Say that again.
So it's a net addition to us in terms of the technology which comes under AI. This would be a net add for us in terms of more opportunities for doing more services and work for our clients.
Absolutely. Because, if your question was that it is not cannibalizing our business, yes, you're right. It's not cannibalizing our business. It is either our business as usual or new business coming to us because customers see that we do so much AI or we have so much capability in automation and AI that brings us newer AI and automation related businesses.
Okay. My second question is on the you mentioned about the market size being quite large, but the addressable segments of what we cater to, what would be the growth rates for the industry for the specific business segments where we are present in?
So broadly speaking, while all the three segments that we are present in are growing at different rates, but they are all double-digit growth rates between 12 to 18%.
Okay, right. And while I understand that you've not mentioned about guidance, but as a more broader trajectory, would you be aiming to be outgrowing the industry growth rates?
That would certainly be the desire, but like I said, desires will lead to our planning and our effort of what we will do. Outcomes is something that will be a combination of various factors, and that's why I didn't want to provide any forward-looking guidance. But absolutely, all efforts would be to not just match, but outgrow or grow faster than the industry standard.
Great, sir. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Agam Shah, an individual investor. Please go ahead.
So most of my questions are answered. Just a quick confirmation. So in the town hall, you said of a vision of becoming a $1 billion company by next 5 to 7 years. So are we sticking to that in terms of process and all?
Visions are definitely, we run with a vision because, it helps us point to a true north and draw our entire strategy and focus the energies of the company towards it. So absolutely, we will work towards that vision. Given that this is, that is a call to action, and this is a numbers-based call, I would certainly caution that, visions are usually lofty, but we would like to achieve or get as close to them as possible.
Okay. Thank you so much, and all the best.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, I said thanks for giving the follow-up. So just wanted to get an understanding in the OPD business which is there. So, what kind of split is in there in the OPD business? How much would be coming from CRM OPDs or supply chain OPDs or finance OPDs? If you can just throw some understanding, what exactly space are we working in the OPD part of the piece, that will be really helpful. And also just wanted to get an understanding on the end user industries. What kind of business, what percentage of business is coming from BFSI, manufacturing or healthcare vertical? Just wanted to get an understanding around that.
So, Mihir, the answer to both parts of your question is the same because we are an engineering services company, we're doing product engineering and digital work. Most of the work we are doing is OPD, right? So if we are working for finance, we are working for fintech OPD, right? We are working for health tech. We are working for auto ISVs or supply chain ISVs, right? So it's mostly OPD work in that space. I can give you the sectors we work at, but I don't think we calculate the split that way currently, and nor would we have the numbers handy to be able to provide that. What we work, where our focus is that covers fintech and health tech, which are two large sectors. We have a big focus on telecom and media. We have big focus on manufacturing, supply chain, IoT. And also travel transportation as well as education. So those are some of the big sectors that we are present in. And obviously, like I said earlier, we are going to deepen our focus on a few of those based on how we see the market traction and our capabilities develop and try to grow in those sectors.
Sure. Just one follow-up to this. We are seeing increasing OPD trend, specifically outsourcing happening from India. So, I just wanted to get a sense, what is the kind of differentiation that we are offering? I understand that broadly that would be that there is little differentiation, but still just wanted to get an understanding. Actually, is there any different edge or differentiation in the OPD side of the piece versus competition?
So, while most of our competition has over time diluted focus from product engineering to generic IT services, at our systems we have maintained our focus on product engineering and basically the OPD type of work for the longest amount of time. What that has done is it has given us deeper understanding of product engineering space, which covers a lot of disciplines, including how do you do the product roadmap, product ownership, and how do you drive DevOps in a product environment kind of thing, which clearly become a differentiator because our buyers are typically product owners or CTOs, and our people actually speak their language. We don't speak general language of IT, we speak language of the product. And that becomes a differentiator when we are interacting with the buyers.
Sure, that's it from my side. Thank you very much.
Thank you very much. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Nitesh for closing comments. Thank you, and over to you, sir.
Thank you so much. I think I'm truly thankful for everyone to attend the conference. Your questions obviously are fairly insightful and continue to encourage us. And we hope to come back and be able to build on the success stories that we shared today and continue sharing them on a going forward basis. So thank you again for attending and all the best for the day.
Thank you. On behalf of our systems, that concludes this conference. Thank you all for joining. You may now disconnect your lines.